digest of the biggest market stories from the past week. Join host Anna Serin and financial expert Bruce Campbell as they go beyond the headlines to deliver cutting-edge insights into news that move the market. Proudly presented by the Canadian Securities Exchange.
Hi, my name's Anna Serin, and I'm Director of Listings Development with the Canadian Securities Exchange. You're joining us for yet another market recap on Friday, May 27th. We are about to approach June, if you can believe it, Jordan. I am, of course, not joined by Bruce Campbell today. As you can see, I'm joined by my wonderful co-host, Jordan Youl. He's with Stonecastle Investment Management. Thank you for stepping in today, Jordan.
Yeah, thanks for having me. It's always good to be back.
It's June soon. Can you believe it?
No, time flies.
I think everyone's going to be happy with the markets the way they are to move into another month and hope for better times. We're going to break down what happened this week in the markets. I know that there's lots going on. We're going to talk about what's happening on the other side of the border in the markets. We're going to talk about, is this just a bear market rally? I'm going to explain what that is, and you're going to tell us what you think. We're going to talk about market breadth. We're going to talk about sector rotation. And then, of course, we're going to get into some CSE issuer news. So what's going on the other side of the border, Jordan?
Yeah, we've kind of broken the losing streak. The Dow Jones has been negative for 8 weeks in a row, 7 weeks for the S&P 500. We're intraday right now, which is definitely constructive and positive, especially in the U.S., given the fact that Monday is a stat. It's Memorial Day, so the U.S. markets are actually closed on Monday. So if we get some follow through into next week, that'll definitely be constructive and positive for the equity markets moving forward. But yeah, this week in particular has been pretty constructive. Most sectors, especially the ones that have been really beaten up, such as technology, financials, consumer discretionary, they're performing well. And then from a market capitalization perspective as well, we're starting to see the small caps and mid cap growth issuers have a strong week so far. But, again, this is very early. If you go back last week or even last time I was on the show when we talked about sentiment and other factors, we were at pretty extreme levels. So from a contrarian standpoint, we're definitely due for a pullback. But the big question is this a bear market rally? Is this market going to have legs in it? Or are we just going to bounce back and then continue this downward trend?
Okay, so moving into our next topic, is this just a bear market rally? So I just wanted to explain to our viewers, bear market rally refers to a sharp short-term rebound in share prices amid longer-term bear market decline. Can you explain to us what you think is going on there?
Yeah, well, technically we are in a bear market. And if you take a look at the makeup and the drivers of the markets internally, there are sectors that have been in a bear market for much longer than just recently. So like, Shopify, Lightspeed, a lot of these companies are down by a significant amount off their recent highs. So, the small to mid caps in particular as well have really been underperforming for about a year now. But technically, at the index level, we have been in a bear market. Now, we'll know in hindsight if the most recent low is actually the low. Like anytime there's so many cross currents that are taking place within the markets, like we're experiencing right now, whether it's inflation, earnings, economic data, breadth, there's obviously a lot of cross currents taking place. But what you need to do as an investor is look at the longer term timeframes. And by looking at a weekly chart or a monthly chart, the indices are still negative. So what we're doing on our end is, we're constantly high grading the portfolios in the strongest areas of the market. So in other words, what the market's favoring right now. But we also do have cash on hand and we do have some hedges in place just because we're not out of the woods yet. And the VIX and other volatility metrics that we do follow are still elevated. So we do anticipate and expect more volatility into the market or into the equity markets moving forward. So we will see, but on the shorter end, on the daily charts and some of the intraday indicators that we do follow are actually starting to turn positive. So we are starting to see that positive momentum in divergence. So what that means is that the price is stabilizing somewhat, but it is also showing us signs that the selling pressure has come off a little bit. So that could be bullish and constructive for the market moving forward as we head into June.
You brought up something interesting, and from my days of being a broker, I remember as far as asset allocation, there was always meant to be somewhere between 5 and 10% in cash. In a moment like this, do you typically try and have a little bit more in cash to be able to take advantage of opportunities, or do you stick to that kind of maintaining of 5 to 10%?
No, we do have cash. So we're very tactical and active on the fund level. So, our income fund right now, we're 45% cash. Our growth funds are around 20% cash. And I'll touch on it momentarily because we are seeing opportunities in other sectors that kind of coincides with the sector rotation we're seeing within the markets. But yeah, without question, we do have cash on hand to be tactical and active to capitalize on opportunities. But also, on the selling side, we also, to manage risk, we use volatility stops. So, despite, the narratives on the issuer side, catalysts, what have you, we do have a defined sell process. So, in this environment, we have been getting stopped out of our positions as well. So as a result, we have been increasing our cash level at the portfolio level as well.
Very interesting. Well, we'll see what happens. I know that, this is where it's these types of markets where professionals really do shine because you guys, obviously, this is what you do every day. You do your due diligence. You're watching the market as a whole and technical indicators. So get professional help. Okay, let's talk about market breadth. Now, I want to ask you about this because we talk about market breadth a lot. And I realize that it's probably important to explain what this is. So it refers to how many stocks are participating in a given move in an index or on a stock exchange. Can you explain that a little bit further?
Yeah, so there's a lot of different factors and ratios that you can track. What's very common is, new highs relative to new lows. So if more issuers are making new 52-week highs, that's constructive and positive. So as the markets are hitting all-time highs, we have more issuers participating on that upside. But what's really common and simple is the number of companies trading above a certain moving average. And two in particular are the 50-day period and the 200-day moving average. So a lot of professionals and investors like to track the number of stocks that are trading above or below that longer term moving average, which is a 200-day moving average. And that's been a real concern for quite some time. Not even so far like this month or year to date. We've been seeing deterioration in market breadth going back to the third quarter of last year. And if you take a look at, what's been performing this week, everything more or less has been positive. But, month to date, it's been pretty much energy as well as year to date. It's been pretty slim pickings in terms of what's been actually making money within the equity market. So I do have a chart of the Wilshire 5000, and this is a great index in the US that can gauge investor sentiment and market breadth because it does include a majority of the publicly traded companies within the US. There's about 5,000 issuers across all market capitalizations. That's in the upper panel of the chart. And you can see, based on the annotations, we still are signaling a negative downtrend. That's what is represented by that red arrow. That hasn't changed. And that gray area is the 200-day moving average. So the takeaway here is that the index remains below the 200-day moving average, and that's not very constructive. We'd like to see that price actually cross above it. But if we take a look at the different indices, specifically in the lower panels, we have the percentage of stocks trading above their 200-day moving average for the S&P, NASDAQ, the Dow, and New York. And you can see that we're around 30% to 36%. So we are seeing some subtle signs of improvement, but we still are quite low. So in other words, there's not a lot of stocks that are actually participating as the markets are recovering. Again, we might be at the early stages of a reversal this week, but we need some time and we won't know until after the fact. But that really kind of coincides with the sector rotation that we'll touch on momentarily, where there's a new opportunity.
Okay, so just a question for you in these types of markets, talking at an issuer level. So, specifically referring to public companies, do you think markets like these will they kind of push companies to go into some kind of or some shape or form of a hibernation mode? So they might slow down raising capital, or they might slow down on their internal growth as a company. Does it kind of all get pushed downhill?
Yeah, I believe so. If you take a look at the leadership, it's been predominantly large cap value quality names, whereas the more speculative, torquier growther names have really lagged and underperformed. And as a result, on our end, we're being very careful with what type of financings we're participating in. If you go back to like a 2017 or a 2020 second half scenario, where we're in a full-on risk-on market environment where market breadth was robust and we had small to mid-cap leadership with a tilt towards growth, we would be participating in more financings, but we're still cognizant of the macro narrative right now that we still remain in a risk-off market environment, longer term. So we have to be very selective. But companies are still issuing stock. Aurora did a deal last night. They did a bought deal.
I saw that. It
Yeah,
was
and
125 million or something.
it was 125 million. They announced it after market close on Thursday, after hours. They upsized the deal this morning to 150 million, but the stock's down 40% today. Right. So,
Amazing.
so in this type of environment, it could be a little bit challenging for issuers.
Yeah, I know that when I was looking at it, it was the offer was less than what the market was doing. So when they're offering, a financing at less than what the stock's trading at, does the stock tend to naturally move down to what they're issuing shares at in the financing?
Naturally, it depends on how tight it is and
Right.
what the demand is. But in this case, this is a stock that reported recently they had $1 billion loss. They're selling their assets in Edmonton for much less than what they paid for. This is a stock that's been struggling. It's down greater than 60% on the year. So effectively, they're raising cash, in a declining market where the underlying stock has really not performed very well.
Yeah, the Canadian LPs they've not had a great time this year so far. Okay, let's talk about sector rotation. So again, I'm going to give a little bit of information because you always give us such lovely information about these. But just so people are aware, sector rotation is a movement of money, invest in stocks in one industry simply to another, and that happens in good markets and bad. But what are we seeing right now?
Yeah, like I've mentioned earlier, market breadth has been a challenge. It's been predominantly energy and some of the defensives like utilities, consumer staples, really driving the market and performing the best year to date. But one of the technical tools that we follow at Stonecastle is a relative rotation graph. And effectively, there's 4 quadrants. And to your point, it tracks the money flow and the rate of change of the particular sector on a comparative basis to a benchmark. So we do have a chart here of the TSX subsectors, and we're comparing them to the TSX Composite Index. So if we look at the relative rotation graph on the left-hand side, we have the TSX subsectors relative to the TSX. In the relative rotation graph, there are 4 quadrants. There's improving, leading, weakening, and lagging. And you can see on the upper right-hand corner, it's been utilities, consumer staples, and energy really being the strongest in outperforming the TSX. And as an investor, you want to be in the improving and leading quadrant to outperform the benchmark. You want to be in the strongest sectors at all times. Whereas we've seen deterioration in materials, which has been predominantly precious metals, but also technology, REITs, and financials. And the relative rotation graph on the left-hand side, in the very bottom, I've annotated a circle of Canadian banks, financials. And you can see financials have really struggled on a comparative basis to the TSX. But, the Canadian banks reported this week. Analysts like the results. They've upgraded the stock. They've increased their target prices. And Canadian financials on the short term actually look pretty constructive for new ideas moving forward. And if we take a look at, on the right-hand side, the same sectors, but compare them to financials, you can see that all sectors have been either improving or leading relative to the Canadian banks up until recently. And you can see the direction of these lines in the relative rotation graph. They're all moving south. So in other words, what that is signaling and telling us is that the rate of change in the underlying momentum is building, favoring financials compared to other sectors. So if you're an investor, you're getting stopped out, or if you have cash on hand and you're looking at, where do we go from here? On our end at the portfolio level, we're looking at the Canadian banks right now for new ideas.
And the Canadian banks are, that's kind of our foundation in Canada for strength and stability, right? So in moments like these, that's pretty natural, a natural move, isn't it?
Yeah, absolutely. They're large cap, they're quality names, they have great cash flow, nice yields at the same time. Historically, when we've gone through, some market turmoil or volatility, the Canadian banks have fared quite well compared to other sectors and even US banks. So, especially in this market environment, if we do want to take a barbell approach where you want to own quality, large cap like Canadian banks, but also look at, some growthier, smaller mid cap, names at the same time. That'd be pretty smart. We're not out of the woods yet, right? So we still have to be cognizant of the macro environment right now. But yeah, the banks look very attractive right now.
Wonderful. Okay, we're going to talk about some CSE issuer news. We have a new listing. It is called Beyond Oil Limited. There's some great interviews with them and our market open. You can check it out on CSE TV. Make sure that you subscribe and then you can see all this stuff. It'll come right to you. Beyond Oil is a food tech innovation company that's developed a unique patented breakthrough solution to eliminate free fatty acids from oil through a green and cost-effective process. This is pretty neat. I love seeing stuff like this come to the CSE. It's a little bit unique. And I think a big part of it is that it's green, it's cost-effective, and it's reducing oil. And what we use at home is one thing, but what's being used on a commercial level is much bigger. What do you think about companies like these coming to market?
Well, it's definitely a niche market. For example, what's going to drive this stock is catalysts. Because it has naturally a low correlation to the markets. What this company does is not going to really dictate the direction of the market and vice versa. So you really need to buy into, the narrative. Obviously, as consumers, we're a little bit more environmentally friendly, or seems like we're going that way. We're a little more health conscious. So if this is an alternative to have access to, high level quality food, that's, going to reduce costs from a business perspective, obviously with rising costs, supply chain constraints, inflationary pressures. As an entrepreneur, you want to be able to streamline the business and reduce costs, but also to eliminate waste in an efficient manner as well. That's healthy for the environment, right? So, this definitely is an interesting story, and it's one that we'll definitely have on our radar. But this is going to be industry and company specific, so we're going to have to watch multiple quarters and get some guidance in terms of what the long-term game plan is as they expand their commercialization. But it's definitely an interesting niche play for sure.
Yeah, it's pretty unique. Well, welcome to the CSE family. Okay, Jordan, let's talk about next week. What are we looking at? And just a reminder that the markets on Monday in the US are closed. What should we think about going into next week?
Yeah, so a couple of things. Looking out a couple of weeks from now, though, is the FOMC minutes, and the Fed has transparently communicated to the market that they will be increasing rates by 50 basis points. So that's probably already priced in. But the bigger picture is, does this market have legs? Are we going to get some follow through from this week into next week and beyond? Or is this going to be a bear market rally? Obviously, we're going to watch earnings and some economic numbers that will be reported on Wednesday and Thursday. But again, we're just taking it day by day. But in the short term, we're definitely seeing some positive signals from our perspective in the technical tools that we use that has us quite excited. But we don't have the green light to go full offense at this time. So, we're just going to take it day by day. But, the banks reported this week. That was fantastic. We'll see what next week brings for sure as more companies report.
Sounds great. Well, Jordan, I always love chatting with you. Thank you so much for filling in today. I hope you have a lovely weekend, and we'll talk to you soon.
Yeah, thanks for having me.
Thanks.